today I would like to share to all of you about unit trust. That you know, the most Malaysian do not have enough saving. In fact, Bank Negara Malaysian has revealed that 3 out of 4 Malaysians are unable to fork out even 1,000 during emergency. What is more daunting is that our cost of living may rise even higher in the future. However, if you have sufficient saving, you will be able to play your daily life without any worries. So, how can you save and grow your money? An easy way to do is via unit trust fund. So, what is unit trust fund? A unit trust fund is a collective investment instrument which allows investors with similar investment objectives to pull their money into a fund. So that is it good to us to invest in unit trust?
Okay, so why do we need to choose unit trust? Okay, so the first important of unit trust is high liquidity. Okay, what is high liquidity? An investor can sell his unit wholly or partially at the following day's unit buying price. Unit have a high liquidity, that is, they can be readily converted into the cash. For example, if you have a properties, you will need to find a buyer that agrees to your selling price, or you may even have sell your properties below the market price. Okay, the second important of unit trust is ease of transaction. Unit trust provide investor with a simpler, convenient and less time-consuming method of investing in securities. The paperwork that come with managing your own portfolio of share and bond are handled by fund manager. So you don't have to worry about managing your own unit trust. Easy, right? Okay, the third point why you need to choose unit trust is affordable and flexible. The minimum initial investment amount is low as compared to other investment. Furthermore, additional investment can be made in even smaller amounts than the minimum investment amount. As unit trusts are a collective investment scheme, the capital investment can go as low as only 1,000 ringgit Malaysia, with each additional investment as low as 100 ringgit Malaysia.
Hi, I will continue with my part, which is risk of unit trust. Investing known to be an adventure that is filled with risk. Unit trust funds are widely known for having lower risk, but this does not mean that it is riskless investment. There are the general risks that are inherent in unit trust investment. Fund manager performance risk. Unit trust funds are professionally managed by funds manager, and therefore the performance of the funds are highly dependent on the manager styles and abilities. Good managers are those who are able to produce consistent good results through good or bad times. For example, if a key member of the fund's management team decided to leave during our investment period, it may have an adverse impact to the investment process. Next, loan financing risk. Financing unit trust investment using loan increases both the possibility of gains and losses. The return of unit trust funds are not set in stone, thus we cannot rely on it to repay the loan. There could be a time when the value of our unit trust holdings falls below a certain level, and we may be required to top up our collateral or reduce our loan amount. When the interest rate is on the uptrend, the cost of loan repayment will increase as well. Therefore, you should weigh all the pros and cons before deciding to finance your fine investment with borrow money. Lastly, country and currency risk. If the unit trust investment are in foreign market and denominated in foreign currency, we may also bear the risk of any changes in the country's political, regulatory, or economical situation that will adversely impact the value of our investment. Any fluctuation in foreign currency, especially the weakening of the currency, will also reduce the asset value of the foreign investment.
Okay, so I will proceed to my title is what is unit trust performance? Yes, a unit trust fund performance can firstly be measured by its total returns. A fund's total return represents the change in the value of an investment in the funds. A bond fund would be compared to other funds with a similar maturity periods or credit ratings. For example, an equity fund would be best compared with another equity fund that invests in companies of a similar business nature.
So here have some advantage and disadvantage of unit trust. So let's start with advantages of unit trust. Okay, first, low risk because of diversification. Number 2, managed by professionals with specialized skills. So you guys do not have to worry because the money will be invested by an expert. Number 3, high liquidity. It can be bought and sold easily. Okay, now let's move on to disadvantages. Okay, number 1 is no capital appreciation. So there's no capital appreciation at all. That they only get the dividends. Second, lack of experience. The fund manager with lack of expertise will affect the trust of their customer. And last but not least is the return may be low. When you invest in unit trust, investor may get lower return compared to investing in stock market.
Now, I want to explain about the pillar of unit trust. First pillar is fund manager. Fund manager representative to unit trust holder to manage trust funds. Second pillar is unit trust holder. Unit trust holder place full trust in the fund management company to represent them in making capital investment in diversified portfolio. Third pillar is contract. Contract that authorizes the person who is delegated to perform a task or work on behalf of the person who give the representative. Now, we move to the modus operandi of unit trust. Unit trust funds works by pooling the financial resources of individual or institutional investor for the purpose of making large-scale investment in a selected portfolio of permitted investment. Okay, firstly, the investor read prospectus, complete the application form and return it with his or her application money. Then, the trustee receive the investor money, pool it with other investor money and purchase investment selected by the manager. After that, the manager issues statements of investment to investors showing the number of units purchased in the fund. Next, the manager looks after the day-to-day investment and administration of the fund's investment to ensure optimal returns. Besides, the fund's investment are valued daily and the capital growth achieved is passed on the investor through an increase in the value of units. The trustee distribute profit from the fund annually through cash dividend or by issuing additional units to investor. The investor receive the cash dividend, or if he or she so decide to pull up his or her investment, they can use the dividend to purchase additional units in the fund.
Next, I will proceed to how to evaluate your unit trust fund performance. There are 3 ways how to evaluate your unit trust performance. So, number 1 is calculate the total returns. The total return can be identified in 2 ways, namely the cumulative total returns and the average annual total returns. Cumulative total returns takes into account the rise or fall in the fund's unit price, while assuming that the income and capital gain distribution are reinvested into the fund. On the other hand, Average annual total return refer to compounded total return, which are measured on an annual basis. Total return compounded over time can rarely make one. Okay, number 2 is compare a fund's performance against its benchmark index. Another way to evaluate a fund performance is to measure it against a benchmark index. Unit trust funds investing in Malaysian equities typically evaluate their progress by benchmarking it against the Kpbkl index. A fund is considered to have outperformed its benchmark index if the fund its returns are higher than its benchmark. Okay, so the last point is consider performance relative to risk taken. One way to measure this is by looking at the Sharpe ratio, which is also known as the reward to volatility risk ratio, which is to measure the historical performance adjusted to the risk of the fund. The higher the Sharpe ratio of the funds, the better the returns generated per unit of risk taken. In other words, when you compare two similar funds, a fund with a higher Sharpe ratio will generate more return for the same amount of risk exposure. Higher Sharpe ratio also indicate consistency in the return generated.
I will continue with Islamic Unit Trust. Islamic Unit Trust is a type of equity fund that collects funds from investors and pools them for investment in stocks, bonds, or other investment products. The return from the investment is paid back to the investor proportionally after deducting the costs related to the fund and administration fee or the fund's portion of the profit. It's depending on the contract used. These funds are similar to their conventional counterparts but differ in their mode of financing and the nature of their investment, which must be Sharia compliant. 3 Islamic contract: Mudarabah, Ijarah, and Murabahah. Mudarabah, most of the funds work on a partnership basis. The fund manager is the working partner and the investor is a silent partner. The fund profits are distributed among the partners, but the only investor loses the initial capital if the venture is unsuccessful. Ijarah. The fund management company purchases assets such as real estate and vehicles and leases them out to the user. The company collects rent for each asset and pools it and distributes it among the investor. Lastly, Murabahah. The fund management company uses investment to purchase asset. It then sells the asset on cost plus profit basis, and the profit that is collected are pooled and distributed among the fund investors.
Okay, so I will tell you about difference between unit trust and share. A unit trust is a product comes out by a fund house which has a group of position in managing the capital gathered.